many ways to get access to the global financial markets. Two options in Australia are exchange-traded funds, ETFs for short, and listed investment companies, LICs or LIV for short. You may have even seen comparison charts that show ETFs outperforming LICs. But there's a problem, a big one. The comparisons often leave something vital out: franking credits. Allow me to explain. Let's say both an LIC and an ETF produce 10% on the exact same portfolio of shares. The ETF pays out the full 10% to investors. The LIC, because it's a company, pays 30% tax first and then distributes 7% cash to investors plus a 3% franking credit. It's the same 10% return, just delivered through different plumbing. The issue is that many comparisons only show the 7% LIC cash payout and ignore the 3% franking credit entirely. So suddenly, it looks like the ETF did 10% and the LIC only did 7%, which is nonsense. That missing 3% hasn't disappeared, it's your tax credit. When you include the franking credit, as you should, the after-tax result is the same for every tax bracket. A 10% portfolio return is a 10% investor return, whether it comes as 10% cash from an ETF or 7% cash plus 3% franking from an LIC. Buyer beware. When there are claims that ETFs beat LICs based on pre-tax numbers that exclude franking, it's not really telling you much about investor outcomes. It's just counting all the ETF income and only part of the LIC income. That's not analysis, that's a measurement error. If you want a fair comparison, include all the value that investors receive in an LIC, especially the franking credits, because structure doesn't determine performance. Thanks for listening.